All right, we're live. It is July 13th, right in the middle of the summer heat, and I'm hot. Let me tell you, I'm hot. Hope everybody's doing great. Good to see you. I see we've got quite a few people on the call already. If you can hear me okay, please just give a shout out, say hi. Richard, how you doing over there?
I'm doing good. Just wondering why my program isn't compiling.
Oh, do we need it today?
No.
For the show?
You don't.
Oh, okay. I don't. You know, I was just looking at the DVOL on Deribit, the volatility index, and I can see we're right at like very, very lows, like literally hanging out at the lows.
32, is it?
Well, the DVOL on ETH is 40.28, and Bitcoin is 42.4.
42.37, yeah, that's right. And the historical vol, the actual realized vol is down to just over 30, 31.
I'm just taking a look. Yeah, it looks like it's about 31.2. You know, it's interesting because I think it was a few days ago or maybe last, I don't know, it's all a blur, but it was in the last 4 or 5 days. I saw some article somewhere or a mention. Someone said that the downtrend in volatility has been broken. I was like, what? Are you looking at the same charts I'm looking at? There's a few little days upticks here and there. That's not a trend break. I don't know. But yeah, we're sitting at historic lows. And in fact, I personally think that we're probably heading a bit lower. That's my personal opinion. We might not. I hope not. I'd like it to creep back up, but I wouldn't be surprised if we crept into the 30s and even stayed there for a while. But I guess we'll see.
Pretty insane. That means that Bitcoin's trading at the same vol as a Microsoft stock.
That's just it. So, and you know, if you think about the traditional TradFi space, you know, option sellers are saying, hey, you know, I'm not going to sell an option unless the volatility gets above 50 or something, which I don't believe in, and I'll actually touch on that in a bit. Now, I think it's good advice to new traders, probably under certain conditions. But yeah, we might be turning into just a regular old asset here. But I think that crypto's still got a few tricks up its sleeves, and I think we're going to be in for some big surprises as usual. Let's see, we got John there from England. No, that's nice. Oh yes, we've got our Italian mafia crew with us today. Excellent. I hope
not insulting Gian Andrea with our characterizations.
Okay, all right. Maybe they're famous fashion designers because Italy's also famous for fashion designers, right? Actually,
or even sculptors of beautiful cars.
Yes, excellent cars. You know, actually, Italy's got a lot going on for it. Now I think about it, it's a wonderful place, and of course they have pizza and all kinds of great things. Okay, so let's get started here. Just checking what we have for our.
Yeah, just a quick apology there to Gian Andrea about the pizza remark. We all know that pizza was invented in Boston.
What?
It's an abomination to an Italian.
What?
Yeah.
Oh my gosh! Come on, everybody knows that. You know, how many people do you know who say, hey, the best pizza I've ever had it was in Rome or something like? Come on. Anyways, let's not get into culinary debates here. So let me jump over to my screen. I'll share what I've got going on. I don't change my chart from week to week. The only thing I'll do with my chart is I'll take off the stuff that's been eliminated from the week before, but it should look pretty much the same. So let me just share my screen here. Window, share. So you should be able to see that. Here, let me make our heads a bit smaller. Richard, your head's in the way. I'm
often told this.
Yeah. There we go. It should be small now. Now, ignore this little bit of printy over here. I'm going to zoom in, and we're going to see that in a second. But if you remember from last week, I had a series of covered calls that were staggered out over the month of July. Now, some of those were covered. These July 14th, well, even last week some were covered. I scale out of positions. I usually don't say, hey, I'm going to make 25% on this, or I'm shooting for 50% or whatever. I scale out all the time. Covered calls, I'll scale out at a higher amount. I think I mentioned that last week. With a covered call, I go for a higher ROI because they're covered versus a naked call. So the only thing I don't have left anymore is these 14 July 2050 covered calls that were taken out next to nothing. As you can imagine, all these are looking pretty damn good. We can see here the price and the date expires. Price, date expires. So as long as the price stays below here, I'm laughing. Again, these are covered calls. So even if it goes above, I'm not losing anything. I'm just losing out on money I would have made by holding the underlying. The greatest threat to covered calls is, of course, if the asset price tanks. If Ethereum tomorrow falls to $800, well, the amount I'm making on the covered call, it would be nothing compared to the spanking I would take on the loss in value in Ethereum. So that's what I've got going on. I was kind of waiting. Normally I would have put some August on by now, I would think normally, but I was kind of waiting for a little push up. Maybe Ethereum could make a little bit of a $200 move and pump up the premiums a little bit, jump in and sell. That hasn't happened, so I'm just kind of waiting for opportunities there. Let me just go ahead and zoom in. I'm going to look at
we almost had an opportunity yesterday with the American numbers, or were coming out. There was some inflation numbers or something. We saw a little bit of intraday vol, but not enough to make it count.
Yeah, and I didn't happen to be sitting in front of the computer at the time, so so. I did take a little bit of a trade, and those who follow us on our Telegram real-time trade alerts channel would have seen this. One evening I was sitting around, and this happened. I'm like, okay, I'll take the other side of that anytime. So what I did was right at like basically 1900 or 1898, I bought some July 11, 1900 puts. Now this is the evening of July 10th, right? So these puts are going to expire tomorrow morning at 10 a.m., right? And that's what this blue line is. It expires. And I said, well, you know what? These are cheap. There's not too many of them. I'm not gonna bet the farm on this. Could this have kept going up or one sideways? Yeah, fine. But when I take these gamma plays, right, because it's got really high gamma because they're really close to expiration and we're at the money. What I did was I just threw out some orders. So I just staggered some sell orders at 60%, 100, 180, and 250% ROI. I just put those orders out there and I went to bed. Woke up in the morning, they were all ticking out except for the 250% ROI. That one didn't quite get hit. So the one or two contracts that I had left, I just took them out at the time at 110% or whatever it was. But that was a pretty nice trade. And I haven't done a scalp like that in a while, but it felt nice. And, every now and then I'll jump on those little opportunities. Now, I will say this is when I do these types of trades, and generally when I'm buying an option, if it goes 50% against me, I'll just get out. Now, clearly I was wrong. So if this thing just kept hovering around here and went sideways, I woke up the next morning and it was 40% or 50 or 60% against it, I just would have covered it. I wasn't too stressed out about this being an overnight because there wasn't a lot on the table, and it just didn't bother me, I guess. Normally, I'd like to be in front of the computer or nearby so that if it does go against me, I can take it out before it gets more than 50% against me. So that's what I'm saying there. But that one worked out very nicely. It was, it was absolutely perfect. So that's what I'm looking for. And we're going to get into this a little bit more in our talk today, because we're talking about trading in this kind of a tough environment right now. And speaking of trading in a tough environment, let me put this poll out. I do have a poll that I wanted to put out. And the question is, have you found trading more difficult this year? Our feedback has been, but I guess it depends on what kind of a trader you are too. Some people might prefer, this not much happening for what they're doing. But most people I know, especially in the crypto space, are used to these, pretty high volatility and big swings and craziness, and they get used to that. So just put your answer in there, and we'll let you know those poll results at the end. Hey, Richard, if you want to share your screen, that would be great. If you want to let people know what's up. Hey, Dom, that's a great. Dom says, I always find trading difficult.
That's a good attitude.
Yes, that is a very good answer. And some years I would have completely agree. Other years you're like, oh my gosh, this is easy. How come everybody doesn't do this? Other years you're like, oh my God, I would just pull my hair out.
In my experience, if it's easy, if it feels easy, it means that you're about to take a fall.
Yeah.
You need to get out of the market. Yeah, so just to touch on Shane's points, the historical volatility, that is the realized volatility averaged over the past 14 days. So we're now at what, 31-ish? Yeah, 31.3. So that's like the volatility of a moderately volatile blue chip stock. So yeah, Bitcoin has become a blue chip stock. Will either make you happy or sad, depending on your point of view. The devol, so this is the daily volatility. This is they take a poll of the 1 month at the money vol. Currently at 42.3, so lower than I like it if I'm going to sell it. You can see the green line there is kind of the baseline of where it's been. And I'm at the moment I'm kind of looking to sell vol every time we spike up, and every time we spike up in vol, I start selling it, and I sell it down, sell it down, and sell it down until we get to about 45-ish, 50, and then I start getting uneasy about it and start buying vol. That's kind of the baseline of what I'm up to. These numbers, between trading vol, well, here between 120 and 40 are kind of arbitrary, but I just actually, one thing Shane mentioned earlier was you said selling vol, not selling vol below 50 vol as a rule is fine for beginners. It's actually a rule I apply to myself as a non-beginner as well. It just stops me from doing dumb stuff. And but sure, you can make money by selling 45 vol and selling it down to 40, or selling 42 vol and buying at 39. Sure, but the margin for error, I just feel, is just not worth the risk. And I don't want to have to be here, in a week's time telling you that I took a 25% drawdown because I was trying to eke an extra percent out of the market that I could have just waited for. So in terms of my positions, tomorrow I've got a bunch of shrapnel going out. I did have some closer to the money things earlier in the week, but I bought them back at low vols and then spread them out. I use this expression, I smear them over the wings. So I buy back at the monies when they're at low vol. So in this case, you can see the at the money is 36.37, which is outrageously cheap in my view. Although we might not move by tomorrow. And then I would go and sell it out at 28th of July or even 25th of August. And so as a result, I've got a bunch of risk smeared around August. I'm short a bunch of calls. I'm short a bunch of puts. This morning I bought some 1x3s. So I bought the 33,000 and sold 3 of the 35,000. Took a net credit on that. And that's just like a short-term gamma play. If we get a spike up, I can sell the in the money call and then manage the risk on the out of the money calls, that kind of stuff. It's just because I didn't. There was nothing.
Richard, Richard, is that the August monthly?
Yeah, that was because that's pretty much the only place I can find any value. Right, July is dead. 38 vol at the money. Even in 10 delta, we're at 47. Yeah. There's nothing that I want to do really. I barely make back my trading fees if I sold the 10 delta, so I don't really want to play around. I've already got enough risk on the table. Why bother? So I thought the 1x3s were a fun play. It's kind of it's not part of my core strategy, but I was bored and I wasn't able to place any strategy trades, so I'm actually just holding back until vols have changed a bit, and then I'll pile in if we get an event. Maybe Friday we've got the Michigan Consumer Sentiment Panel preliminaries. Next Tuesday
we have some numbers today as well. We have PPI today, don't we? And
yeah, but the market hasn't. Well, unless something changes when the US opens, we'll see.
Yeah.
And this week I've been smearing some risk around the calls in September. I found some vol there. So we had a situation this week where the skew was negative inside 3 months, but positive beyond 3 months. And so I thought I'd take advantage of that and buy some near dated puts and sell some long dated calls, just as a statistical, vol play. That's pretty much where I've been. But
okay, cool.
Yeah, I'll come back to performance a bit later.
All right. Yep. How's your margin? We usually talk about margin. I've got almost no margin risk on right now, but
Yeah.
you're always running a bit more than I do because of the type of strategy you run.
So the Deribit margin system is obviously fundamentally margined in bitcoins, not dollars, and my account is there printing dollars. So the first thing I do whenever I have some Bitcoin in my account is I sell perpetuals against it, or dated futures, depending on the interest rate differential. That's actually something else I did mean to put into this episode, but we can probably cover it in the next one. Early this week, you could sell a 1 week future and buy the underlying and receive something like 20% APR, APY. In
20%.
Yeah, it was immense. So I had lots of debates with my partner in crime in the fund I'm building about whether we should do a sub strategy of interest rate arbitrage. And the thing is, we were just worried about we're actually monitoring it and see what happens in tomorrow's expiry, because we were concerned about whether when you're trying to roll the futures out into the next week, whether it's just going to crush the vols and you're going to get hosed on trading fees or execution risk. So we're looking into that at the moment. But it looks kind of, there are times when it's quite promising.
Interesting.
And we've been looking at the differential between the perpetual funding rate and the, as you know, I hate going long perpetuals because you get unknown risks in terms of the realized interest rate. But if you've got spare, for me, if you're looking to print dollars and you've got some spare Bitcoin in your account, then actually being short some futures or short some perps, just prints money. It's like earning interest.
Cool. All right. So today we're talking a little bit about this market. And when I'm looking at the poll results right now, about 55% of people are saying that they're finding it more difficult this year. 22% say same, and 22% say no difference. So, more people find it more difficult. And again, it's a function of a few different things. From a macro perspective, the markets have just quieted down. IV's just not there. Things just aren't moving like they used to.
Actually, if you're in that 55% of, then you're with me. I'll show you some graphs a bit later on how the change in markets has affected my trading returns and how I've had to modify strategy and tweak parameters to eke the last bit of value out of the markets.
Interesting. Yeah, I'm looking forward to that for sure. So let me jump over the slides, and I'll just show you something that I put together. Richard and I put together, but a lot of it talks about kind of my philosophy. As you're going to see, Richard and I sometimes disagree on things, all kinds of things, cool cars, trading, you name it. We don't always think the same, which is a good thing because it's a nice counterbalance. And it just, not everyone trades the same. Everyone has a different way of viewing things. And there's not necessarily a right way or a wrong way. There's okay, PETA. But anyways, there's a lot of ways to skin a cat, right? So let's carry on. Oops, hang on. My thing just disappeared. Hang on. There it is. I'm back. Okay. So let's talk about this market. It's a tough one for a lot of people, and trading profitably right now involves a few things. But why is this so challenging right now? Well, Richard put these points in, and he said, look, market volatility is very low. We all see that, allowing the market to arbitrage away excess value. A lot of market participants are simply out of cash. So there's only those few left behind, those survivors that are sticking around, and they're still actively trading to some degree. There's a strong net selling volatility by miners who need to earn US dollars as a return. Optimism is embryonic, meaning fewer natural call buyers, but there are opportunities out there, and there's always going to be opportunities. Now, there's two general approaches we keep taking to keep the income flowing. Number one is systematic, which is Richard does more of. When I apply trades, I'm systematic about them, but he's systematically putting trades on. The second point here is selective, being very patient, very opportunistic according to market conditions, and taking an opportunistic look at a lot of it looks a lot different in a high IV environment than a low IV environment. So I'm always opportunistic with my trading, but I'm just taking different opportunities. in each environment. Because, man, I've been, gosh, I remember years where I was trading where it seemed like nothing happened. Like you were just waiting for the market to do this. And you thought, how long could this actually continue? Trust me, when it ends, it ends. And everybody's like, oh my gosh, this is the craziest thing ever. And that lasts for a while too. So, these doldrums do happen. They're not just a summertime phenomenon. So trading profitably right now, here's the common logic in trading. Commonly people say, hey, you know what? High IV, sell. Low IV, buy, right? You sort of, on the trend. If it's high, it's going to come down and you'll sell, you buy it back cheap. If it's low IV, eventually it's going to go up. So you buy it and you sell it high. You want to be on the right side of that trend. And I do agree with that. And that's all very good, good advice. But after years of trading, I have tweaked that a little bit. When it comes to long trades, and I'm going to talk about long trades here for a second, because when we get in these low IV environments, people are like, okay, well, this is going to change at some time, right? I want to be long when this market breaks out. Or there's no money in selling, or there's little money in selling. So the only thing to do is to go long. Okay. And that can work. But with long trades, you got to be right on timing and direction. If you get the timing right, but it's late in the life of the option, you've lost nearly all the time value. And the price of that underlying really has to make a move for you to make any money. If you get the direction right, that move has to be big enough to overcome the break even. If you're in a slow market, what are the odds you're going to get the size of the move you need? What are the odds that the IV is going to increase when you need it to? I mean, we can go sideways for the next 3 months. Who knows, right? You need to be precise on your trade exit as well. So you kind of got to be damn near perfect in order to make a living off long trades this way. I'm not talking about scalping. I'm not, this very specialized forms of trading where, you're going long all the time. Fine. With long trades, you can stagger these out over multiple expiries. So we'll look at the market. We're thinking, hey, it's going to break out sooner or later. It could be tomorrow. It could be September. Heck, it might be December. I don't know. So we're going to stagger out a whole bunch of long strangles or whatever we're planning on doing. You're going to spend a lot of money on doing that, especially if this low IV, the moves are slow and they might eventually get to some of your targets, but if they do it slowly, all the value would have bled out of your option. You're not going to make any money on them. If that move comes, let's say the move comes in the middle of October, will you make enough to offset the costs of buying all these options that all expired worthlessly, or you bought back at 50% loss, or whatever your rule is? You're going to offset that. I don't know. Are you going to, run out of money before a move pays off? A lot of people, this is a good way of chipping away your account. Just chip away, chip away, chip away. It sucks. Okay. The other thing too is, what's your mental attitude going to be like? That move doesn't come for 6 months. You're going to be frustrated. You're going to be angry. A lot of times, then when a move does come, people are inclined to exit early because they're like so grateful to get a bit of money back from the market, and that move may or may not run. Right. So your exit, sometimes people break the rules on their exit because there's so much they're trying to make up for and they don't know what to do. They get out early or they hold on too long. Right. So if you last, it's typically one big payoff between long periods of not much going on. So I'll admit that buying IV has the best odds when IV is low, because we know it's going to go up at some time, but there's never any guarantees. There's never any guarantees in trading at all. So how are we continuing making profits in slow and low IV markets? Well, I got to tell you, selling is still the primary strategy. But there's a caveat in there. You got to reduce your size and you have to go limited risk. Richard made a comment before that, he still does have the 50% rule. And I think it's a great rule. There is money to be made in lower IV environments. Just don't expose yourself to unlimited risk, Let's make, so we're going to sell debit spreads or sort of credit spreads. So it's a spread. So we've got protection there just in case the market does some stupid thing one day. Fine. Scale into positions. I'm also scaling out of positions, as I showed you on my chart. And I'll often look at shorter date expiries. We get a little bit of action. Vols pump up a little bit. I'll jump in there and sell that, assuming that the vols are probably going to settle back down. And that's exactly what we're seeing right now. Will that continue? Well, it'll continue until it doesn't, right? If I'm going long IV, I'm probably going to do it limited risk with spreads, right? A vertical, maybe a calendar spread. Why? Because it's going to cost me less. If I'm going to spend $200 on a long call, why don't I sell it as a spread and I'll spend $100 on it? That way, if it doesn't work out and I do this over and over and over for a few months, I'll spend half the amount of money that the guy did it buying naked options. Okay. And also, you want to stagger that expires. If you bet everything on this market moving by August 28th, and here we are, August 15th, you've lost almost all the value out of your options. You don't want to blow everything on one expiry. So you want to stagger those expires because we don't know when the market's going to move, when IV is going to start expanding again. And I will look for those high gamma trade opportunities, like the opportunity I showed you. I took that trade on the night of July 10th. Boom, the market made a big move. I'll take the other side of that bet any day of the week. I'm not risking a lot. Fine, it worked out great. If it didn't, I'm not going to worry too much about it. I don't bet the farm on those, but I'm happy to take those opportunities. And that just kind of supplements the income. Maybe I do that once a month, maybe 3 times a month, maybe once every 3 months again. I mean, it doesn't matter, right? Just, a little bit of money goes back into the pot. It's all about scaling expectations, because I found that in years past, when I was on a trading floor, you got used to making X amount per year approximately. And it's funny. I don't know what happens. It's the universe signals going out or what happens. You end up kind of repeating the same thing, and you kind of hit that ceiling, right, where you can't seem to break above. It's like, well, why can't I? But when the lean years come, you expect you'll continue to keep making that same amount of money, but really you've got to scale it down. You have to lower your expectations in different markets. The markets are always going to change. They're dynamic, and they always will be. All right, so here's Richard's slides and Richard's thoughts. That's my thoughts on what I'm doing. Again, my summary is I'm still selling. I'm still selling. Like Richard did, he's waiting for little spike ups in vol, and he goes in and he sells it. I'm doing the same thing. But I'll have to admit, my theta is a lot lower than it was last year. Maybe half, maybe a third, maybe even a fifth on some days, because the theta is always changing as price moves. But you know what? You just got to be patient and wait for those opportunities. But selling is still a primary strategy. I just do it in a limited risk way, and I'll look at the shorter dated opportunities. So go ahead, Richard.
Yeah, sure. So what you're looking at is the historic returns of the systematic strategy that I've been running. And you'll see that over 2001 and 2002, which, by the way, was a bear market year, it's printed pretty good money. So it started with one Bitcoin, which at the time was about $30,000, and we turned it into kind of $90,000 by the end of 2022, at a pretty good lick. And then you'll see that this year, and it's actually since October last year, the effect on the market has been dramatic. That the red line is almost horizontal, and we've had more volatility of returns for less money this year. So that's the strategy that I just figured out on the back of a fag packet. Sorry, that's a British term for the Americans, a cigarette packet. It was quick and dirty, and so no. I've for the past 2 years I've had no concerns about paying to be taker to hedge. Didn't care about trading fees. Didn't care about inefficiencies. Didn't care if the strategy was doing dumb things sometimes. But this year you can see that approach has meant that returns have been super flat. So I've been working with my boffins at my fund, and we went back and reran back tests and tried adding some tweaks and rules into the strategy, not changing the strategy, because the back test told us that the fundamental strategy was correct. The fundamental strategy should be making money, but actually all the money we were making was being chewed up in trading fees and spreads. I'll just say that again. All the money we were making was being chewed up in trading fees and spreads. So there is definitely profit and there's definitely value, but you've now got to find a way to get that value out without spending too much in fees and spreads. And by value, I mean, this strategy still prints 40% a year, as you can see by the change that we made. So we added some rules that didn't allow the strategy, because this strategy is run by a robot, right? I mean, we've invented the strategy, but we run it systematically. And we did a couple of things. One was we made the auto hedger a lot tamer and a lot less aggressive, so it spent less money. And we also made the auto hedger actively market make into position rather than be a taker of liquidity. Now, this test account is run on a standard deribit account, so it's paying, is it what, 5 bips or 4 or 5 bips to be a taker on futures and 0 on maker. And so the problem should be obvious, right? So every time we hedge, and there's been a lot of hedging required because we've had low vol, but we've had a fair amount of movement intraday, and we've got to keep our deltas under control. So we're forced to hedge, and if we start burning 5 bips every time we hedge every one Bitcoin of delta, then that's like 5 basis points is what, $15. We could end up burning, I don't know, $90 a day, and that's all our theta gone. So that was a major change. And then the other one was a rule change to prevent the algorithm from actually writing risk when it was not advantageous. So such as today, we went to write risk, and looking at the market, we saw that the realized vol was super low. Okay, it's still lower than the d-vol, but one of the positions we wanted to write was a 20 delta call, and we looked at the vol and thought, you know what, I'm not going to sell this vol for less than, say, 45, and the vol just wasn't there. So okay, we'll just save that allocation for tomorrow, and we'll sell it tomorrow, not today, because just selling at 45 is probably okay, but selling below that, you're starting to get into territory where you're going to end up spending more on your hedge than you are on your on the profits you make from that trade. And of course, you're spending, was it 3 or 4 basis points on putting the trade on. So you want to make sure you get enough premium in that trade to make it worth writing the option in the first place. And then the same with puts. So with the puts, we actually monitor the risk reversals in the market. So we monitor the difference between the 10 delta calls and the 10 delta puts in terms of the implied volatility. And we have a little rule there which prevents us from buying options when that indicator is too low. And again today, so yesterday we had negative skew, so the puts were more expensive, so we didn't buy any puts. Today skews have gone roughly 0, I think today. Yeah, roughly 0 into delta. So we're not doing much today, but the day before there was positive skew by 10. It was the 10 delta calls were 10 vols higher than the 10 delta puts. So we were definitely buying puts 2 days ago, just because of just a value calculation. We still want the protection, but we didn't want to pay for it that day. So as you can see, the line still isn't as steep as it was in the last 2 years, but it's still but now it's going up, and so it's going up from had we done this. So we reran the back test all the way back from beginning of 2021. What we found was during the past 2 years we would have made 25% more money. Because if you look at the previous, well, I'll show you the comparison later. We made 25% more money, and this year we continue to make money. So actually, we changed the strategy this week, and already this week we've started seeing a significant, noticeable uplift in returns.
Richard, I have a quick question for you. So when you said because the fees are gobbling up the profit. With the auto hedger. So you made the auto hedger a bit more tame. So it wasn't hedging either as often, or you spread out a little bit. So how big of a difference was that in terms of how frequently it was trading or how often it traded, did you find? And are you noticing slightly bigger drawdowns than before because it's not hedging as fast?
So what we've done with the auto hedger is before it was saying if I get to a certain threshold of delta, I will start hedging and I'll go into aggressive mode and I'll start hedging aggressively. And if I get beyond another delta, I'll start super aggressively hedging, so that we keep the. And so if it gets aggressive, it's just keeping the delta at zero consistently and not letting it deviate until the market slows down. So that catches the time when you get a massive run from 25,000 to 31,000, and that keeps you from losing much money during those runs if you're short gamma. But if you do that as taker, like I say, I think on that $50,000 account, that systematic account I just showed you earlier, my test account, we traded something like $1.5 million of futures in 1 week, and spent an enormous amount of money, like $1,000 in fees.
That's a ridiculous amount of trading on a $50,000 account.
Exactly, yeah. So it had to work, but because it was the hedger was set to get really aggressive and to preserve value at all costs, and it did preserve value. The account lost a bit, but not much, and it left us with protecting our principal. But it gave away a load of profits that we painstakingly earned. So what we've done with the hedger now is that first of all, it refuses to be a taker. So it's a very stubborn maker, and so it'll detect that the deltas are starting to get big, and it'll then start aggressively market making to prevent them from getting big. And it's only if there's a massive move, like a second threshold is breached, that it will consider being a taker in order to hedge away the emergency, and then it will immediately go back to being a maker. And what we wanted to do was avoid these situations. We get them about once a week, where the market will do nothing for 3 days, and then it will spike by $1,000 and then fall by $1,500 and then come back to $500. It will basically be net zero on the hour, but within that 1 hour, it's just burnt a load of fees. Now, another thing we've done is widen the tolerances a bit. So we took the view that we're happy to accept like $1,000 up and down in the day without hedging. We can deal with that on the overnight hedge, or when we're placing new trades, we'll re-hedge on the new trades on the next day. But if it's more than like $1,000 or more than $1,500 movement, then we want to start getting aggressive about it to prevent the loss getting any worse. And that kind of helps us to get out of the situation where we're hedging these bogus moves in the market that aren't really going anywhere, but that look dangerous at the time. So we're accepting some short-term losses in order to sort of preserve the overall health of the book and preserve fees, on the basis that the market right now is incredibly mean reverting until it isn't, right? So that $6,000 move we had the other day, fine. We'll hedge that. We'll hedge $4,000 of it, and we'll accept a loss on the $2,000 of it. That's kind of where we are right now.
It's funny how you've widened these tolerances, and you're okay. Like you said, net on the hour, price hadn't hardly moved, but it has a big up, a big down. And as you know, I'm using futures to hedge off a bit of risk. Even if I've just sold some covered calls, I'll still use futures to do that. And I was finding that I've been widening out because of those moves, and that's also why I feel a lot more comfortable going in on those high gamma plays, because we get this big spike up. The thing's probably coming right back down. If it doesn't, no big deal. I'll deal with it. But we've got pretty good odds of that happening. So I'm kind of taking the other side of these. Either I'm selling if the vol spikes a bit, or I'm going long for as long gamma plays. So there's ways to make money in this market, and that's how I'm doing it. It's interesting that this market condition has given something to both of us in the way we look at the market.
Actually, that thing you just said, I really like that idea of you leaving those spoof long put orders in the market at sort of 5 bips, just in case there's a spike and you get pushed into a position super cheaply. I like that a lot. I'll be doing that because that'll teach them for doing these daily spikes.
Yeah, and I don't know if there's a way we can back test that data, but maybe we could turn that into a strategy. We'll have to think about that a little bit. Yeah,
I'll talk to my guys about that, because that's fascinating.
Cool. Is that the last thing you got for us?
Oh, sorry. Then I had a summary screen. Sorry.
Okay.
I did myself with my level of preparation. I made 3 slides. So here's the difference between the so on the left hand side is the pre-tweak systematic strategy. You can see it's still pretty good, except for this year it starts getting a bit tired. And then the post-tweaks. This is just the updated hedging and the adding the filter rules to the strategy to prevent it doing dumb stuff. And you can see that the PV rises from 3x, 30,000 to 90,000 over 2.5 years to 30,000 to 140,000 over 2.5 years, with a good chunk of that profit still coming from these quiet markets. So this will be the strategy that we're locking in our fund from now on. This actually has a Sortino of 7, which is astonishingly good. So that with that level of consistency of returns, you could afford to leverage up by like 5x easily. So if you were, you could borrow money and then turn 30,000 into like 500,000 in 2.5 years.
Let's not start making any credit claims here. But one thing I will say, okay, let's just say that next year the market goes back to the old crypto market we used to know. We've got 80% volatility and we're all over the place.
Yep.
Is your strategy, will you go back to having tighter tolerances? Will a higher IV cause you to have to tweak that again, or will you leave it like this? Do you think it'll actually even be better in a higher IV?
This strategy has been back tested across not just the current market conditions, but also over the past 2.5 years, just to be sure. And in fact, and as you can see by the right-hand graph, it actually improved the returns in the initial 2 years, as well as improving returns now. So it was an all-round improvement, and we only did it because we were forced to, because the market forced us to stop being lazy and go and do the work. And just to touch on your thought, if the market transitions back into high volatility, which we all hope it will, then we will take a drawdown for about a week. If it's on the upside, then we will probably suffer maybe a 5, maybe 7% drawdown. If it's on the downside, 4 to 6 probably, because we carry a lot of downside protection in this strategy. So actually, if the market fell off a cliff, like 25% drop in Bitcoin, we'd be more than happy. We'd make money on that because we have so much protection there.
Gotcha. Cool. All right, we're going to go to the Q&A section in a second here. Actually, I'll just quickly mention we always have something for Deribit Live people, but we've decided that we would just do a free trial instead of the system we had before. So if you want to join us, for example, is our silver package, you get access to our academy, our interactive live trade alerts channel where we post our trades in real time and we chat there. We talk with people, can ask questions, and we're starting a weekly call, which will be running, which will be a lot of fun too for a lot of people. Get a lot of questions answered there. So you can always visit our page if you want to join for a 7-day free trial. Okay, let's go to the Q&A. And actually, I'll just give everybody a poll update. The poll spiked up. When people were having a difficult time this year, went up to 67%, and now it's back down to 56%. But 56% of people found trading more difficult this year, and I concur with them. About a quarter of the people said no, and 18% said no difference. So that's kind of interesting, but I don't think that's too far out of line with what we were expecting. Let's go to some Q&A. So we've got some questions from Luke. We've got a few questions, actually. So in a video some time ago, you explained to hedge carefully. And in another video, you said that you are fully delta neutral. I guess both are correct, but can you please explain when to use one and when to use the other? That'd be a question for you.
Yeah. So when the baseline strategy that I run to make my living is delta neutral, and that means that it's no secret that every hour we expect to be 0 delta in the account, and we allow some deviation around that. And in fact, we do allow some deviation in the light of the recent market changes. We allow some deviation around that during the day. But overnight, day to day, we want to be sure that when we're putting risk on the next day, that the deltas are all hedged to zero, and so we at least start the day delta neutral. And that's just kind of a way of preventing the delta getting out of control. We also take a view during the day on whether we think the rally or the sell-off is meaningful, and that's a bit of experience and a bit of algorithmic input, and whether we would start hedging earlier than the allotted hedging times to sort of start taking some of the edge off the delta that's building up. That'll, if we've got nothing at the money, or no short positions at the money, and maybe we've got short positions 10% away from the market, then we would be more happy to let the delta move around. If we're short at the money straddles, then we're going to be a bit more tight on the hedging, and might even just seek to move those straddles out to a later date further from the money. If we are long gamma, if we're in a position, I mentioned that our systematic strategy has a bunch of long puts in it. So if we get a sell-off and we're suddenly deep in the money on those long puts, and all of our calls are worthless, and and the account's gone net gamma positive, then we're going to the hedging changes behavior, and we just use hedging then to hedge to zero delta in order just to lock in profits on any intraday moves. We talked about hedging carefully back in our episode about how to roll a position, didn't we? About how hedging, if you hedge early and you've got a little bit of a delta hedge in there, then when it does come to roll a position, then that roll can be less painful. So that's based on the idea that you're selling, for example, more what Shane does than I do, which is to sell a call spread or a put spread or both, and then hope that it doesn't get in the money and take action if it does. I tend to take action a bit sooner than that, but what Shane does, is just start to, if the trend is against him, he'll just start to edge into futures, maybe not hedging away all the delta, but just so that if there is a run up and he does get in the money, then he's got some value in his future to help him with the cost of rolling. That's hopefully covered the question.
All right, fair enough. Same question from Luke, or another question from Luke. Can you use open interest to predict future volatility?
There's a load of speculation about this. I don't know what the numbers are in reality. People say that, oh yeah, it's a massive expiry, it's going to be violent. But in reality, really, everyone in the market is already hedged. So you might have a load of open interest, but all that open interest is already gamma hedged anyway, with futures or offsetting option positions in other expiries or other strikes. So the institutions aren't going to care, to be honest. If you've got a load of open interest by amateurs who are not hedged, and there's a big move on expiry day or the day before expiry, then yes, you could inject some volatility into the market. The question is whether the options market in crypto is big enough to move the spot market. Because of all the hedging, the old tail wagging the dog. I don't think it is at the moment. I think the spot markets are still bigger. And so I'm skeptical that there is anything to the value to be gained by looking at open interest.
And I completely agree with you, because I can think of, over the last years and years and years, you see these headlines, biggest expiry happening, this Friday, and nothing happens.
Yeah. I've
seen headline after headline after headline. Some days things do move a bit, but it's never this craziness that's always been predicted. So, so how do you select the calls and puts you buy or sell? Do you only or mainly consider the vol?
So that's different between me and Shane, right?
Yeah.
I'll answer for me, and then you answer for you. I care about, if I'm selling an option, I care about nothing other than how much theta am I going to get, and how much gamma do I have to pay for it. So I'm looking for the best theta per gamma. And at the moment, I don't mind telling you right now, 2-week calls are about where that is. 2-week 10, 20 delta calls. That ratio is about best. Now there's also the Vega risk, So that won't Vega doesn't really affect you if you're running your own account and no one's watching your P&L. But if I'm running customer money, and they are going to be watching daily to see what the performance is, then Vega is something I'd take very seriously, because I could just go and sell a bunch of, I don't know, 100K Bitcoin calls, and say bollocks to the people who think we're going to be $1 million Bitcoin in a year, and I'll just hedge the delta, and I'll just pull in all that theta over the year, and I could do that in spades. But the problem is that when the markets get violent and the at the money 1 month vol goes from 40 to 70 or 80, then you can be sure that the 1 year vol out at 10 delta is going to go from like 90 to 300, and suddenly my P&L starts looking really bad, and people will stop pulling their money out. So if it was my money, I'd be happy to go and sell it there. But if it's other people's money, I can't, because of the optics. Mm-hmm. But in general, I'm looking for the best theta per gamma.
Mm-hmm. Yeah, and I apply on the stupid people rule. So if things move, I just think, well, where are the stupid people at? Where's the market at? And I'll look at the technicals too. So let's say, I generally would sell a 20 or 30 delta call. It's kind of the area I feel safe. That being said, if we've just had a massive move, and let's say Ethereum goes up 15% in 2 days, I'm getting a little bit more comfortable at selling a 40 delta, maybe even a 50 delta. Thinking, you know what? That's I'm okay. In shorter term, maybe maybe I'll stagger them out, but I'll also look for resistance. So if that 15% move goes up, and I've seen some big resistance up there on a technical, I'll sell calls above there no matter what they're at. Maybe they're an 18 delta, maybe they're a 28 delta. I don't know. I'll just sell those. So I just look for the opportunity where I think I'm going to have the highest probability. So I'm kind of just looking at probability, because I want to collect either all of that theta or a chunk of it. Very rarely do I collect all the premium. If I sold an option and then the market a call option, the market turned around and tanked, tanked, yeah, I'll hold it. I'm not going to hold it till expiry. Usually I'll get rid of it when it gets sub 10 delta. It's 8 or 5 delta. I'll just get rid of it. It's just no point in holding on to that risk. But that's how I kind of look at it. A little bit more opportunistic, and I look for stupid things to happen in areas of support and resistance. If I'm doing covered calls with futures, when I close my options leg, should I also close the futures position, or does that not matter? It's an interesting question. A question from Dom.
Unless you're going to immediately write another covered call, absolutely, because you've just gone from, let's say your covered call is 10 delta, you've got 90 delta risk on the future and minus 10 delta on the call. You've 100 1 delta on the future and 0.1 on the call, so you're net 0.9, and without the option you're now net 1 delta. I don't know what your position is on owning Bitcoin. I consider owning Bitcoin a risk to my dollars, so I will never own a Bitcoin without hedging it with futures or options. If you're a Bitcoin maximalist, then of course you are hoping that the market's going to go up, and you don't care if the market's going to go down. Then you may want to hold on to the future, because you'll have considered yourself lucky that you got a bit more Bitcoin by selling the call. So absolutely depends on your point of view. I pay my bills in dollars, and my performance is measured in dollars. So for me, not losing dollars is the primary concern. If you measure your performance in the number of Bitcoins you have, then by all means hold the future if you can afford it.
All right. A question from Michael. So sorry, maybe a bit off topic. I'm going through your course, which is the options fundamentals course we have. How to understand volatility increases as the option becomes increasingly in the money or out of the money. Does it mean that in the case of a bull momentum, market participants think that the price will go up even more, and therefore the IV is higher in calls than puts at matching the same strike prices?
Yeah, so we did I think the first webinar we did for Deribit, it's on YouTube. I got super technical and started talking about trading the smile. So the smile is the shape of the graph of volatility per moneyness or per strike. And you tend to find that the implied vol will increase the further away you get from the money. So today at the money 1 month, we're looking at say 39% vol, and the 10 deltas are 43% vol. So today, quite a shallow smile, but that can get quite steep. And it's as you say, the Black-Scholes model assumes that the market is perfectly random, and an up or down move is just as likely any from one day to the next. But you and I both know that, particularly crypto markets, people they start speaking on Twitter and Reddit, and they all join in on these bull run channels. They all pile in at the same time, and then you get whales coming in and swamping and making what everyone else does totally irrelevant. And the reality is that the Bitcoin market is not stochastic and it's not Brownian. So it'll pick up a trend and it'll run with it. And so the Smile model is there to try and model that using Black-Scholes equations. So I think that my catchphrase is that pricing options is using the wrong equation with the wrong inputs to get the right answer, right? And that's what we do. So we increase the implied vol on the out of the money options in order to price in the risk of a run if it does get its head on, which means that most of the time the far out of the monies are good value, most of the time, but never ever sell them unhedged because they'll kill you.
And in traditional markets too, you'll find that 99% of the time, if the market goes up, vols are going to drop. Everybody's happier. The prices are going up. Volatility tends to drop. It tends to only rise when the markets go down.
But actually, yeah, but Bitcoin's different.
That's why I said traditional markets.
Yeah. So Bitcoin volatility tends to go up when we go up or down at speed.
And that'll be interesting to see if that changes as Bitcoin and Ethereum become, let's just say they continue to become more mainstream. Will it, follow the patterns of traditional markets? That'll be interesting to see. Another question from Luke. When you buy low vol at short date and sell vol at a later date, does it have to be the same strike price or does it not matter?
So because I hedge with futures constantly, it doesn't matter. You can think if you stay delta neutral religiously, then what you'll find is that whatever you sell or buy, all you're really doing is buying the volatility price off the surface. And so selling long-dated high vol and buying short-dated low vol, or is it the other way around? All you're doing is just relative trading on those various parts of the surface. And the assumption is that as you roll the trade that is expiring into the next week or 2 weeks or whatever, it will roll towards the expiry of the other one. And over time, if the markets are perfect, it should be a zero-sum game. So for me, no, it doesn't matter. I'll just sell or buy the vol wherever I can find it. I don't really care about that. I never look at the strike, to be honest. I never look at the price of Bitcoin.
Cool. Andre asks, where do you get the data to run back tests? Good one.
So you can hook up your own thing to Deribit and start dragging all the ticks off it via the API. Also, we use a firm, and I'll plug them, even though we haven't told them and they haven't paid us to tell you about them. But we use a firm called TARDIS, TARDIS.dev, and it's run by one guy who has sat there and sucked all of the tick data off all of the exchanges since they opened. He's got terabytes of data, and it costs you about, I think I pay about $10,000 a year to get all of the derivatives ticks back through time and for the future.
Do you do options arbitrage trading across exchanges as a systematic trader? Take advantage of misplacing, for example. Mispricing, I think they meant to say.
Not yet, but the intention is to do it. And what's really helpful is you've seen an announcement recently that Deribit has got its integration with Copper done, and there's the custodian, and that's actually very useful for cross-exchange arbitrage because it means you don't have to move any money you can just leave your money in the custodian, hook up the custodians to the various exchanges, and then as long as you maintain enough margin availability in your pool of money on a custodian, then the exchanges are comfortable for you to trade without actually sending them any money. All you send them is the residual settlement P&L every day or every hour, or whatever the number is. So that's something that we want to get into, but not there yet, because there's just been so much other stuff to do.
And when that happens, I wonder how long it'll take for those spreads to come in, for those arbitrage opportunities to get narrower and narrower. I mean, there's going to be a period where there'll be great opportunities, but eventually the market's pretty efficient.
It's worth remembering that whichever exchange you trade on, you're probably ultimately trading against the same market makers, and wherever the flow comes from, they don't care. They will mark their vols accordingly. So what controls the option prices is mostly the weight of trading against certain areas of the vol surface. That will cause the market makers who start picking up inventories to start repricing their vol surfaces in order to get rid of it, and that they'll then feed those vol surfaces out to all the exchanges. So it doesn't really matter, to be honest. I mean, we do a bit of market making, but it's small fry compared to what the market making firms do.
That's an interesting point, that you're trading against the same people no matter the exchange, because there's a handful of big players. Yeah,
and that's the same in TradFi as well, right?
What's the minimum account amount to trade options on Deribit that still makes sense? Questions from Def.
So if you are going to do Bitcoin, you could do a covered call strategy on Bitcoin with 0.1 Bitcoin, because the minimum trade size on Deribit is notional size 0.1 of Bitcoins and 1 Ethereum.
Mm-hmm.
So,
and for everyone out there who speaks proper English, not means zero.
So about $3,000 it would be the minimum. There'd be certain strategies that you then couldn't do.
Yeah,
but yeah, you could start with $3,000.
And what's your suggestion if someone wanted to trade Ethereum options?
Well, you could start with 1 Ethereum, because you can do covered calls on 1 ETH, which is what, $1,800.
Yeah, about
1881.
Yeah. 1,900, almost 1,900.
Yeah.
Yeah. Okay. So a question from Gene: do you make any use of the options flow, gamma exposure, max pain, open interest?
Yeah, that's the same question really about of whether open interest affects spot markets, and the answer is not yet. Give it a year. If anyone from Deribit's watching this, they're going to be very happy for me to say this. Give it a year, and you'll find that when options markets are 10 times the spot markets, as they are in the traditional world. So the whole reason that 2008 happened and long-term capital management and Bear Stearns went bust is because the amount of derivatives at risk in the traditional markets are thousands of times more than the amount of actual money there is in the world. So that, in the end, has to happen to crypto too, because everyone's greedy, right? And everyone's going to leverage up. And in fact, even now, we know people are leveraging up quite heavily in the options markets. So it will start to be a factor, but at the moment, I ignore it. Yeah, it's irrelevant.
All right. Another question from Dom. He says, sorry for so many questions. That's okay, Dom. That's what we're here for. The selling weekly 40 deltas, as we mentioned last week, we did the back test. We talked about selling a weekly 40 delta. How would I look to manage those? When to buy them back, when to roll, etc. Also, if vol pops during the week, would you look to sell the same option, i.e. trade more than once a week? Excellent questions, because these are all things we've discussed, because the test we did, we had to create a baseline, right? Said, okay, let's sell the 40 delta, let's do the 30, the 20, and let the thing run to expiry, and then sell another one. What are the results? And we both said, we're probably not ever going to actually do that. We're probably going to manage that trade at some point, whether it gets at the money or whatever the rule is. So these are all excellent questions, though.
Yeah, I think we'd be getting dangerously close to investment advice if we started answering that in detail. Obviously, I think the backtest tells me that selling weekly 40 delta calls is a good strategy as a baseline. Is how can I improve on the returns? So that made us what, 10%? overall per year.
Actually, I don't remember the return
20,
on that
I
test.
forget what it was.
Yeah.
And we discovered that 40 deltas were the best one to sell because they brought in enough premium to cover the drawdowns and all the rest of it, whereas the 20s and 10s didn't. But look, if we had you almost always get a dead cat bounce if you get a sell-off. So if I've sold a 40 delta 1 week call and I get $1,000 sell-off, if I'm anywhere near the keyboard, well, actually, screw it. I'll just leave an offer in at 5 or 10 basis points, because if we get a sell-off, I want that back. And then if there's a bounce, sure, I'll resell it. Why not? I'll get 2. And I think that definitely in the current markets, you definitely see that. Every week you see this kind of bounce and dip, and so I think that that's a reasonable strategy. Then the question is, what happens if that option expires in the money? Do you rewrite it at the same strike, i.e., in the money, in the hope that the market is going to mean revert? And what you've effectively done there is actually converted your covered call into a covered put, into a cash covered put, strictly speaking. Or do you accept the loss, the intrinsic loss, and move your next strike to be the 40 delta of the next week? That's a judgment call. That's like, do I believe this rally is continuing, or do I believe that the rally will mean revert? And that, Shane spends more time looking at tea leaves and charts than I do. I don't care about that kind of stuff, and I don't believe in it anyway. So I would probably backtest it and do what the backtest told me, which is probably this year sell it at the same strike, and last year, the year before last, probably roll it.
Are we able to pull a test to say, okay, add a layer on to last week's test and say?
I'll make the request. I'll see if people have got time to do it.
Okay.
Yeah.
All right. Last question from Gene. What are the risk tools you use for your trading?
So I use a firm called Immersive Finance, and I think we put a link in last week's video. We'll put another link in this week's video because we're friends with them. Run by Will McGee, who was my boss, my MD at Citi when I worked there. Extremely clever guy, knows everything there is to know about options pricing and risk. They're institutionally based. They face institutions. And we are in talks with them to see if we can start providing some lightweight tools to non-institutions. They're skeptical because of all the, if you get 1,000 people using the service, suddenly the support calls multiply by 1,000. So they currently sell to hedge funds and wealth management firms and so on. And I happen to use them because I work in one of those. But other than that, you could use the APIs to sort of build something for yourself quickly. And I think there are some free services out there that do some stuff. Got a very active guy in our Telegram channel, Vincent, who kept posting links to services you can use. So there's stuff out there.
Yep. Fantastic. I think that's it. Just take a look at the final poll results. Surprisingly, only 50% of people say this year is difficult, or just.
Well, that's because they've listened to us and they've changed their trading strategies already, and they're already finding it easier.
Amazing results. Amazing. Yes, because the no's went up to almost 30%. So there we go. It's just a matter of shifting. Sometimes your focus, sometimes your expectations, and hey, it's a lot of different trading styles. So I hope everyone found this useful. I think there's a lot of good nuggets in here, a really good conversation. And we will see you all next week.